Welcome to The Explainer. Today, we're dissecting the 1772 collapse of the British East India Company. You know, we hear the phrase too big to fail tossed around a lot today, right? But this is probably the ultimate historical case study in systemic financial risk. We're going to look at exactly what happens when a single corporate entity gets so incredibly massive and so deeply intertwined with the global economy that its failure literally threatens to bring down an entire nation's financial architecture.
Just pause for a second and really consider the sheer scale of this. We're not talking about just a trading firm. The East India Company was a multinational behemoth that ultimately governed 90 million people. Just imagine, say, a modern tech giant or a megabank, but operating with its own legal system, minting its own currency, and holding absolute territorial control over an entire subcontinent. They ran a massive chunk of the world purely for profit. To really put that unbelievable scale into perspective, they commanded a private army of 260,000 soldiers. Think about that. That was twice the size of Britain's actual military at the time. So you had shareholders sitting comfortably in London boardrooms who practically owned equity in one of the largest standing armies on Earth. It's just a staggering historical reality. Okay, so here's our game plan for this explainer. We're going to start with the 1772 panic itself, then we'll look back at how this massive corporate empire was built, examine the deeply flawed mechanics that led to its ruin, trace the financial contagion that followed, and finally wrap up with a blueprint this all left for modern corporate power. Let's jump right into the first part, the 1772 financial panic, a corporation on the absolute brink. We start right in the thick of it in 1772 with a massive crisis that threatened to completely unravel the British fiscal architecture. And mind you, this wasn't a central bank failing, and it wasn't the crown going bankrupt. It was a private enterprise. Stock prices were absolutely collapsing on the London market. Company executives, who were known as nabobs, were being accused of massive, rampant corruption. And because major banks were so heavily exposed to the company's skyrocketing debt, this sudden stock freefall triggered a severe credit freeze across the entire British financial system. To make matters worse, the government relied heavily on customs duties generated from the company's imports. If the company went bankrupt, the state's baseline revenue completely collapsed. It was, without a doubt, the ultimate too-big-to-fail dilemma. Now, to understand how we actually got there, let's move to building this corporate empire, from simple spice traders to a sovereign power. We really have to flash back to 1600. Back then, voyages to the East Indies were incredibly dangerous. Ships sank, pirates attacked, and capital was super scarce. No single investor in their right mind wanted to risk total, absolute ruin if a ship went down in a storm. So they introduced this idea of pooled risk. By selling tradable shares to multiple backers, they distributed that financial exposure. It completely revolutionized commerce. I mean, it's the exact foundation of the modern equity markets that drive capitalism today. If a ship sank, hey, you only lost a fraction of your investment. But if it returned full of silk and spices, everyone shared in the massive profits. It was a real game changer. Tracing their aggressive evolution, you see this massive, seismic shift. They started as a modest, though definitely risky, 17th century spice trade monopoly with a royal charter. But fast forward to 1757 and everything changes. Following a major victory at the Battle of Plassey, company forces decisively defeated the Nawab of Bengal. With that single victory, they secured territorial power over one of the richest provinces in the world. They shifted overnight from mere merchants to a sovereign corporate state, eventually expanding that private army to 260,000 soldiers by 1800. But here's where things start to crack. Let's look at the mechanics of ruin, or how they built a giant house of cards. With immense territorial wealth came unprecedented systemic risk, completely driven by a deeply flawed business model. They had basically built an engine of incredible profit, but structurally, it was totally bound to implode. You see, they constructed a truly unprecedented self-financing machine. Instead of using imported silver from Europe to buy goods, they effectively used foreign tax extraction to completely fund their global supply chain. Step 1, collect land taxes from millions of Indian farmers. Step 2, use that exact same tax revenue to buy local Indian textiles and opium. And Step 3, export those goods globally to enrich their shareholders. It was this closed, perfect loop of maximum profit. But I want you to consider this core vulnerability. It's a huge one. If your entire global supply chain and your massive London stock valuation are fundamentally based on taxing local farmers, well, what happens when those farmers can no longer pay? That brings us to a devastating reality. Between 1769 and 1770, a horrific famine swept through Bengal, tragically killing millions. Agricultural output completely collapsed, and with it, the company's primary source of revenue, those land taxes, plunged dramatically. Yet company executives, those nabobs we talked about, largely ignored the humanitarian crisis. They just kept right on extracting vast personal fortunes from the region. Meanwhile, back in London, the corporate treasury was taking on massive, unsustainable debt just to keep paying out high, promised dividends to their shareholders. The financial math simply stopped working. So what happens when the money finally runs out? That brings us to the bailout and contagion, the real too-big-to-fail dilemma. When the cash dried up in 1772, the stock collapsed, London credit froze, and the British government violently woke up to the fact that the state and the corporation were completely inextricably linked. And this created a stunning domino effect of contagion. To help the struggling company generate some quick cash, Parliament passed a law in 1773 allowing them to dump their massive surplus of tea directly into the American colonies at cut-rate prices. Well, this deeply undercut local colonial merchants and caused absolute outrage, which, as you probably know, directly sparked the Boston Tea Party. It's wild to think about. A corporate bailout designed to save a London balance sheet literally helped ignite the American Revolution. Lawmakers realized they had absolutely no choice but to intervene. It marks one of history's earliest and most consequential corporate bailouts. Through the Regulating Act of 1773, the state extended a massive government loan to stabilize the company and stop the economic contagion. But there was a catch. In exchange, they imposed strict parliamentary oversight. Politicians were finally waking up to the profound, systemic danger of unchecked corporate power. Which leads us to our final section, modern parallels of power and the blueprint for today's empires. The East India Company was eventually nationalized in 1858 following a massive rebellion. But its corporate DNA, it's still very much alive today. The structural lessons of 1772 didn't vanish, they just evolved. The crucial takeaway here is the structural parallel. The fusion of capital, political influence, and global reach remains a defining feature of modern economic power. Sure, today's multinational giants might not command private armies, mint their own currency, or directly extract physical land taxes like they did in 1772. But think about modern asset managers allocating trillions of dollars, or tech platforms governing massive digital ecosystems. They wield a structural influence that easily rivals actual nation-states. From joint stock ownership and mobilizing capital markets to limited liability for investors and global supply chains spanning continents, the East India Company pioneered the exact mechanisms that define modern capitalism. They deeply integrated commercial and political strategy. They proved that financial hubs could project unprecedented power globally. But maybe more importantly, they issued a glaring warning about the dangers of too-big-to-fail scale and leverage. They showed us that when a company's pursuit of profit becomes structurally essential to a nation's baseline economy, disentangling the public good from private ruin becomes nearly impossible. The 1772 crash was fundamentally driven by massive scale, insane leverage, and relentless profit extraction. So, I'll leave you with this provocative thought to chew on the next time a multinational giant faces a crisis. When a company grows powerful enough to rival a state, who truly holds the reins of power? Is it the boardroom or the government? Thanks so much for joining me for this explainer. I hope it gave you some fascinating historical context for the systemic financial risks we still navigate today.